Well, hello everyone, and thank you for joining us. Welcome to Australian Retirement Trust Super Insider Podcast. The purpose of today's podcast is all about putting money into your superannuation. So how do I get money into super? What are the types of contributions I can put into superannuation? Because putting money into super, even if it's a small amount over a long period of time, can make a big difference, because your superannuation grows not only by the amount that you're putting into your super, but that money is invested. And that attracts growth, that compounds over time. So your money is growing by the money you're putting in, but it's also getting that growth over the long term. So it can make a big difference. So very important topic. Now, why should I put extra money into super? What's it going to do for me? It could reduce my taxable income. It could certainly even help me retire sooner, because I've done so well. I've put extra money aside. I can enjoy that retirement a lot earlier. And it could also just mean I've got a better retirement lifestyle. I can go on those extra overseas holidays. I can upgrade that car, get the new car that I want to do. So a great reason to consider contributions into your super today. So look, my name is Kane Everingham. I'm joined by my colleague April Smith today. We are part of the education team here at Australian Retirement Trust. Welcome, April.
Thank you, Kane.
All right, so look, April and I, we get to speak to thousands of people across the country about all things superannuation and retirement. And one of the most common things that comes up is about contributions. Like, how do I put money into super? There's a lot of rules and regulations there. So we're going to try and demystify a bit of that today and go through some of those topics there. So after listening to this episode, hopefully you'll have some great ideas that you can take away and implement in your own situation. I do have to say, I'll tie this in, anything that April and I say today is general advice only. What that means is we're going to talk about a whole range of things. They may not all be appropriate for you, so please do your own homework. You might want to seek financial advice or consult the product disclosure statement of your super fund just to see if these are appropriate for you. So I can't stress that enough, because some might apply, but not all will. So look, April, what can our listeners expect to learn today?
Thank you, Kane. So firstly, I'll just talk about maybe contributions in general. And most people might know of contributions as their employer contribution, which is what's called a super guarantee amount, which is an amount that your employer is required to pay into your superannuation account. Currently for the 24-25 financial year, that is 11.5%. And then next financial year, it is growing to 12%. So the reason why we do receive this from our employer is so we can live a dignified retirement. But what we're going to talk about really today is what can we do? What can we do extra to put into our superannuation and grow it? And as you said, Kane, maybe we want to retire earlier. Maybe we want to go to the Kimberleys or go to France or Cambodia or whatever we want to do and have that option. So today we're going to be talking about what is a before tax contribution, what's an after tax contribution. We'll also talk about the home downsizer contribution. And then we want to talk about some strategies that you and your partner might want to look at doing. So that's what we're going to be covering off today. And we do want to touch base, or just let you know, these contributions are going to be very different for everyone. So one might be suited to somebody else. So what we want to do is also touch base on who these might actually belong to, these types of contributions, because there is a variety of them and people may not be aware of which one to choose. So Kane, I'm going to get you to take us away firstly for before tax contributions. What are they?
Okay, so before tax contributions, or the technical term is concessional contributions, you might have heard. So effectively, they're any type of contribution that goes into your superannuation account and receives a concessional rate of tax, or a lower tax rate. That's where the name comes from. So these are contributions that are then taxed within super, not at your payroll. So commonly, the most common ones, employer contributions. Any salary sacrifice you do into super, they're all concessional contributions. If you put money into super and then claim a tax deduction on it, that's classed as a concessional contribution. So these contributions are taxed at up to 15% in your superannuation. As I said, not taxed at your personal PAYG rate. So concessional contributions like salary sacrifice, there's something you consider when you start hitting the higher income tax brackets, because as I earn more, I'm getting into those higher income tax brackets. Salary sacrifice can reduce my taxable salary. So it could be a great tax effective way to boost my super, but also reduce some of my tax. Another reason why you might look potentially at, say, the tax deductible contributions, I might be self-employed, or I might have a job on the side. I speak to my accountant. We're coming in, if I'm coming in at the end of the financial year, the accountant might go, hang on, you're up for a big tax bill. So there might be a benefit for me to put money into super and claim a tax deduction on that to reduce my taxable position there. So that could be something that's appropriate there too. So another one is a great scheme called the First Home Super Saver Scheme. So it was set up where effectively any contributions I put into super, they can actually help me save for my first home if I'm eligible for this scheme. So it can be, again, a great tax effective way to save for my very first home. Mm-hmm. So that can be another way that you can use these. So now with before tax contributions, I'll stick with that term because I think it's less of a mouthful than concessional contributions. Just be aware that there is an annual limit. So it's just not a free for all. So for the 2024-25 financial year, the annual limit is $30,000 per year. And I need to stress that includes your employer contributions. So that just doesn't mean I could salary sacrifice $30,000 myself if I had the capacity to do so. I have to be aware it does include my employer contributions into that $30,000 limit there as well. So remember, there is that limit for the 24-25 financial year of $30,000 a year. However, if my balance is under $500,000, I do have the ability to carry forward any unused cap from my previous up to 5 years prior. So I'll give you an example. So let's say, for the 23-24 financial year, the limit was $27,500. If between my employer and my own salary sacrifice, let's say I'd use $17,500 of that. So I've still got $10,000 from last year I hadn't used. I'm now in the 24-25 financial year where I've got my new $30,000 to use. So I can technically do my $10,000 from last year that was unused plus my $30,000 for this year. So I could do up to $40,000 in concessional contributions in the 24-25 financial year. With anything like that, you can go to the MyGov, go to the ATO section there, and you can have a look if you've got any unused cap that could be available to you. That's an overview, of all things before tax contributions. But April, I'll throw it over to you now for after tax or non-concessional contributions.
Yeah, another fancy word, non-concessional. I might use after tax because that's effectively what it is. It's a contribution that goes into your superannuation after your income tax has been applied. So as opposed to what you've just mentioned before tax, where they're taxed within super, it's already taxed at that income tax or a marginal tax rate, you might know that as. Because you have already been taxed, the caps are actually a little bit more generous. So what you could effectively put into your superannuation per financial year for the 24-25 financial year is $120,000. And you can actually regroup or do 3 years at once. So combine all your 3 years, putting in $360,000 at once. Now, I did mention there, this is a 24-25 financial year. So depending on when you're listening to this podcast, these figures may have changed. And because we are putting in this large amount into superannuation, I do also want to highlight those considerations, eligibility. It will depend on your age as to if you can make those contributions or not. It will also depend on your balance in your superannuation. And also these funds are going into superannuation. So superannuation is really there for your retirement. So generally, to be able to access those funds again, you do need to really kind of meet that generally age 60 and over, and whether you're retired or whether you are still working, there might be either a part amount that you can access or the full amount you can access. But let's see who's going to be putting in these after-tax contributions. So maybe you've sold an investment property, maybe you've sold some shares, maybe you've received an inheritance. But more often than not, I've actually spoken to a lot of people who just have funds sitting in the bank account. And what they really want to do is put those funds into superannuation so that they can take advantage of that compounding effect over time. So they're wanting to look at making sure those funds grow or fluctuate over time, but ultimately get that growth over the long period of time on those funds. Now, those after-tax contributions, Now, I've actually just spoke to you about, larger funds going into your superannuation, but I also want to talk about the benefits of just putting in maybe a little bit of spare change into your super. And I remember speaking to this lady. She used to come into ground floor when I used to work on ground floor, and she'd come in every fortnight and she'd give me $3.30 or she'd give me $20.50. It was all very specific. Sometimes she might have had $50. And all of those amounts that went into her superannuation, she tried to put in up to $1,000 into her superannuation. And the reason being is because she was working casual. So, as a lower income earner, if she put in $1,000 into her super, she would have been entitled to the government co-contribution, where the federal government puts in $500 into your super. So that's actually an incentive where you're getting about 50% guaranteed return on your money. But to be eligible to receive that, you do need to be a lower income earner. So maybe a part-time or casual employer, this might be more suited to. And what they do is if you're, now for the 24-25 financial year, if you do earn under $45,400, then you may be entitled to the full $500. But if your income is under $60,400, then there may be a sliding scale to your eligibility to how much you can actually receive from the government co-contribution. So really, they're the types of contributions. Maybe you want to put in a large amount, or maybe you want to just put those small amounts in to get that government co-contribution. But let's talk about another contribution now. What's the home downsizer contribution? What if I sell my house? What if I don't have a superannuation account? Can I open one later in life?
Sure. So, so the government have got what's called the downsizer scheme, or we'll call it the home downsizer scheme. So essentially what the government was trying to do with this scheme was it's designed for older Australians. I'm selling my larger family home, I'm downsizing to a smaller, cheaper home, and I'm effectively able to put some of the sale proceeds that I haven't used into my superannuation. So that can be a great boost for people who I haven't got much super. The family home's my biggest asset. I'll pick on myself as an example. So my wife and I, we've got 2 young boys. So we've got a larger family home. We've got a yard for the boys to run around in. We're not going to need that when the boys are growing up and flowing the coop. So we're a perfect example of this scheme where we would be absolutely looking to downsize, because I don't want to be doing the yards all by myself. So, so downsize, buy something smaller and cheaper. And then I've actually then got access to extra capital to help fund my retirement. So under the current rules, if I'm over 55 and the home was owned by my spouse or I for 10 years or more, then I've got 90 days from the date of settlement to actually put up to $300,000 of those proceeds into my superannuation account. If my partner or my spouse is over 55 as well, then we can do 300 each. So that could be up to $600,000 from the sale proceeds we could put into our superannuation. So look, some cool things about the downsizer contribution. It doesn't count towards those contribution caps that you heard April and I speak to earlier. There's also no upper age limit. So generally, once you reach age 75, you're unable to make voluntary contributions to super. So the downsizer contribution actually provides older Australians a great opportunity there. So look, big thing to be aware of this with this strategy though is there can be that impact on the age pension. So your home that you're living in isn't accessible by Centrelink, but if I sell that house and get extra proceeds and then put them into super, that is accessible for the age pension. So that could impact age pension eligibility and the amount you're getting. So again, can't stress enough, like with anything we've spoken about today, do your homework, get financial advice if you are interested in something like that. So look, another key topic that I think we need to cover, and I'll get you to do this, April, is spouse contributions. That could be another great way to look at getting money to super. So I'll throw it over to you.
Yeah, excellent. So there's 2 types of spouse contributions that we could look at. One's called a spouse contribution, and the other one is splitting your super. So really transferring some of your super to your partner's account. I'm going to quickly just touch base first on what is a spouse contribution. So a spouse contribution is just simply paying money into your spouse's account. Let's say, for example, your spouse is a lower income earner or maybe not working. What you could look at doing is effectively transferring transferring $3,000 into your partner's account, and you can look at claiming up to 18% as a tax offset, which is up to the value of $540. So that might be something you want to do. You might looking to, grow your future nest egg for retirement, and that's just really, $3,000 going into your spouse's account and potentially you receiving that tax offset of up to $540. Now, I also want to talk about spouse splitting. And spouse splitting basically means just transferring some of your funds into your partner's account. So what you can actually transfer is you can transfer up to 85% of your concessional contributions or before tax contributions up into your spouse's account. So for example, let's say for the year, I might have put in $10,000 of employer salary sacrifice or tax deductions for the year. I could actually transfer $8,500 over to my partner's account. Now, it's still going to count towards my cap, so that, $30,000 that you mentioned earlier. But what I can do is I can transfer that to my spouse's account. So 85% of those funds. Now, I might look at doing that because maybe I want to be, generous. I want to, make sure that my partner's super grew when they may have taken some time off to look after, our children or even maybe parents later on in life as well. But there are, certain circumstances as to why you might split some of your super to your partner's account. And they can be based on really your age. Like, if I want to transfer up to an older spouse, or if I want to transfer to a younger spouse. Now, I know, Kane, you are a former financial advisor and you used to talk to your clients about, or your older clients, about transferring some of those money to a younger spouse. Now, why would you have actually done that?
Okay. Yeah, so good question, April. It's quite common. The main thing you want to think about is when you hit pension age, wherever you've got your money, it will be accessible. So if I've got it in an accumulation account, if I've put it into an income account, if it's in the bank, that money will be accessible for when I apply for the age pension. Now, if I've got a younger spouse, so let's say I'm 67, I've hit my age pension age, I'm applying for the age pension, but I've got a younger spouse who's under age 67, so hasn't hit their age pension age. Anything they've got in an accumulation account in superannuation is not accessible by Centrelink for the age pension. So I might look to, as the older spouse, I might look to split my super contributions, my concessional contributions down to my younger spouse to build up the retirement nest egg we've got, but in the younger spouse's name. Then when I apply for the age pension, my younger spouse's accumulation account will not count for Centrelink, so that could maximise my age pension entitlements. Obviously, then when my younger spouse eventually gets to her age pension age, then it would be accessible. But that could definitely make a big difference over a few years, particularly if you've got a quite a big age gap as well. So that can be a great thing to think about. Now, I'm going to kick it back to you, April. What if we go the other way? Why would there be a reason that you might want to go from the younger spouse to the older spouse?
Yeah, okay. So this is really interesting, isn't it? There's these two different benefits. So if, let's say we've got Hannah and Joe. We talk about this couple and there might be a 10-year age gap. So let's look at Joe, who may be 45 and Hannah may be 55. So Hannah's going to look to be able to access her super, potentially retiring at 60. So she can look at accessing her super from the age of 60, depending on whether that's the full amount or the part amount. So what Joe's wanting to do is he wants to transfer those funds up. So 85% of those funds up. Now that might be because, he wants to retire with Hannah. So they want to have a bit more money in those earlier years of retirement so he can retire with Hannah. Another reason might be just to pay off some of those pay off the mortgage. Might be to go away on holiday, really just to have those extra funds there in the account to do, what they want to do. But the caveat to this is you really need to do some forward planning for this one, because you can't actually transfer up into your spouse's account if they are 60 and retired and able to access that super, or over the age of 65. So really forward planning if you are a younger spouse that's looking at transferring up to the older spouse. So there is really a myriad of heaps of different reasons as to why you might choose to split some of your super, whether it's to an older or to a younger spouse. There's also eligibility requirements. As I mentioned there, age is one of those requirements. So do some homework, call your superannuation fund, no questions too silly. So please, if this has piqued your interest, definitely look into it a little bit more. But we've gone through all the types of contributions today that we wanted to talk about. So what's the key thing that we want to leave our listeners with?
I would say the earlier you can engage with your super, the better. Now, look, it's never too late, but the earlier you can do something, the better. So that might be, I can only afford $20 a pay now to put into super. Earlier you start doing that, the bigger difference it's going to make, because we spoke about earlier, that compounding effect, that growth over time. So I'd say pay attention as early as you can. Make that decision to do something as soon as you can, because it will make it. Older you will think younger you, let's put it this way. Now, look, we have taken you through various ways you can put money into your super. And as we've stressed throughout, please make sure when you're thinking about these, if any of them piqued your interest, are you eligible to even make that type of contribution? What are the benefits or things you need to think about for your own situation? Does that apply? Are they going to help me get where I need to go? How do I even make this contribution? Right? It sounded great, Kane and April, but how do I do it? So you need to find that out. And then also be aware, how much can you contribute? So be aware of those limits and the different rules and regulations there. So again, you'll find a lot of great resources online. Your super funds will often have a lot of great articles and helpful facts and figures on their website. You've got the ATO, you've got a lot of places there to help. So look, on that note, though, April, where can our members go if they want to get further guidance and support?
Yeah, so I guess, our job is really education, and that's what we would always kind of recommend and talk to our members about, is educate yourself. There is so much to learn about super, and I've been in super for 12 years and I'm still learning. So I can completely understand when people do come over to their super fund, they don't even know what questions to ask. So that is what your super fund is there for. They know what may be relevant for you based on your age, based on your salary. But this is where you would maybe look to get some financial advice. So see if your super fund, because at Australian Retirement Trust, we have advice that's part of your membership, and your super fund might even have that as well. And that basically means that your super fund's able to get you in touch with, what you should be doing. So as we mentioned before, all these different types of contributions, they're not going to be for everyone, but they might be for some people. And what's right for your neighbour might not be what's right for you. So talk to your super fund, play around with some calculators on the website, go to the ATO website, do some research, ask for help, talk to as many people as you want to talk to. But otherwise, I think it's time to wrap up, Kane.
Yeah, absolutely. Thank you, April, for joining us today.
Thank you, Kane, and thanks to our listeners as well.
Beautiful. So look, April and I, we hope this has been helpful to you. As always, we'd love your feedback or suggestions for any future editions. Drop us an email. The best way to get us is podcast@art.com.au. That's podcast@art.com.au. If you like the show, the best way to support us is subscribe. There's a link in the episode description as well. And thank you so much for listening to Super Insider. We hope you enjoyed it and you can join us next time. And as we always like to finish off saying, look, the best time to do something with your superannuation was yesterday. The second best time is after you listen to this episode. Thank you.